Listen, I want you to take a second and look at the screen, or just imagine it. Imagine you're sitting in a room with 20 different monitors. On every single screen, there are flashing red and green numbers, complex charts with lines zigzagging everywhere, and news anchors shouting about the next hot tech stock or some new crypto coin that's supposedly going to the moon. You're trying to pick the winner. You're trying to find that one needle in the giant, messy haystack of the stock market. It's exhausting, isn't it? And honestly, it's meant to be. This is exactly how our friend Mark felt just a couple of years ago. Mark was convinced that to fund his retirement, he had to be some kind of math genius or a professional trader. He thought he needed to spend 3 hours every night after work when he was already tired analyzing balance sheets and chasing the latest trends he saw on Twitter. At one point, he had a portfolio with 40 different stocks, 5 different themed ETFs, and a whole lot of grey hair starting to show. But then, one day, Mark asked a question that changed everything. He sat back, looked at his messy portfolio, and asked, what if I'm making this too hard? What if the path to financial freedom isn't a complex maze, but a straight line? In this video, we are going to explore a strategy that sounds almost too simple to work. We're talking about building an entire retirement, your whole freedom fund using just one single ETF. We're going to look at the data, we're going to run the year-by-year numbers, and I'm going to show you why this boring approach is actually the secret weapon of the world's most successful investors. By the time we're done, you and Mark will see why having one master key is better than carrying a heavy ring of 100 keys that might not even open the right door. Let's pull back the curtain on the only ETF you might ever need. Now, before we reveal the chosen one, we have to address the elephant in the room. Why does the world make investing seem so incredibly complicated? Well, you have to think about it from Wall Street's perspective. If a big bank convinced Mark that investing is a dark art that only experts can understand, then Mark will gladly pay them a high fee to manage his money. If I can convince you that you need a complex portfolio of 20 different specialized funds, I can sell you more products. Complexity sells, simplicity doesn't have a high profit margin for the banks, but Mark realized something powerful during his research. He found a staggering statistic that blew his mind. Over a 15-year period, nearly 90% of professional fund managers, people with PhDs from Ivy League schools and multi-million-dollar supercomputers, actually failed to beat a simple market index. Mark thought, wait a minute, if the pros can't beat the index by being complex and smart, why on earth am I trying to beat it by being stressed and tired? That was his light bulb moment. That's when he decided to simplify everything. He wanted one fund that owned everything, one fund that didn't require him to be a stock-picking genius. And that brought him to the doorstep of the total market strategy. So which ETF are we talking about? While there are a few great candidates, Mark decided to focus on a broad market titan, something like VOO, the S&P 500, or VTI, the total stock market. For the sake of this breakdown, let's focus on the powerhouse, VOO. When Mark buys just this one ETF, he isn't just buying a stock, he is literally buying the 500 largest, most profitable, and most successful companies in the United States. He's buying Apple's innovation, Microsoft's software dominance, Amazon's global logistics, and NVIDIA's AI future. He's buying the American economy in one single transaction. But here is the absolute beauty of it. If one of those companies fails, if a giant of today becomes a dinosaur of tomorrow, Mark doesn't have to do a single thing. He doesn't have to sell anything or read the news. The ETF automatically kicks out the loser and replaces it with the next rising star. It is a self-cleaning, self-healing machine of wealth creation. Mark realized that by owning this one ETF, he stopped being a speculator and started being a business owner. He wasn't betting on a single horse in a race anymore. He was betting on the entire track. And historically, the track always wins in the long run. But wait, I remember Mark had a serious concern. He thought, if I only own one thing, am I really diversified? Isn't it risky to put all my eggs in one single basket? This is where the math really comforted him. You see, even though he only sees one line item in his brokerage account, he actually owns 500 different businesses across every single sector: healthcare, technology, energy, consumer goods, finance. He realized he was actually more diversified with this one ETF than he was back when he was picking 10 random stocks he heard about on some news segment. The psychological shift was even bigger than the financial one. Before, when one of his individual stocks dropped 20%, Mark would panic. He would stay up at night wondering, did I make a mistake? Is this company dying? Should I sell now before it goes to zero? But now, if the S&P 500 drops, Mark knows it's just the market taking a breath. He knows that as long as the world keeps spinning and people keep buying products, the index will eventually recover and hit new highs. He stopped checking his phone every 10 minutes. He stopped worrying about quarterly earnings calls. He finally got his time back. And as we always say on this channel, time is the most important ingredient in the snowball effect. Now, this is where the conversation gets real. Mark sat down and asked, okay, this sounds good in theory, but if I just buy this one thing and I never touch it, how do I actually reach that retirement number? So we ran the numbers for him, and I want you to see this. Let's imagine Mark is 30 years old today. He has a modest start, maybe $10,000 he's managed to save up. He commits to a very simple, almost boring habit. He's going to invest $1,000 every single month into this one ETF. No matter if the market is up, no matter if it's down, or if the news is saying the sky is falling. Let's look at year 10. Mark has been consistent. He's invested a total of $120,000 of his own money. But thanks to an average 10% market return, his portfolio isn't worth $120K. It's worth roughly $200,000. He hasn't had to pick a single winner. He just stayed in the game. At this point, the dividends are starting to buy a few extra shares every year. The machine is starting to hum. Now, let's jump to year 20. This is what I call the tipping point. Mark is now 50. He's been doing this for 2 decades. His portfolio has ballooned to about $750,000. Think about that for a second. He's still just buying that one ETF. He's not a hedge fund manager. He doesn't have a team of analysts. He's just a guy with a simple plan. His money tree is now tall enough to provide some serious shade. Finally, we reach year 30, the finish line. Mark is 60 years old. Because he stayed disciplined, didn't panic, and didn't try to get cute with his strategy, his one ETF portfolio is now worth a staggering $2.2 million. Let that number sink in. $2.2 million from just one ETF. No stress, no complex trading, no paying 2% fees to a broker. Just consistency and time. But then Mark asked the ultimate question. Okay, I have $2 million on a screen, but how do I actually pay my rent? How do I fund my life without a paycheck? This is where the famous 4% rule comes in. If Mark has $2.2 million, he can safely withdraw 4% of that every year to live on. That's $88,000 a year or over $7,000 a month for the rest of his life. And the math says there is a very high probability that his money will never run out. And the best part? He still only owns that one ETF. He doesn't have to learn a new, complex system for retirement. He just sells a small slice of his haystack every month to fund his adventures. However, as Mark got closer to his goal, he started wondering if there was a way to get even more cash flow. He loved the growth of VOO, but he started hearing about other ETFs that were designed specifically for income. Looking back at his journey, Mark realized that the biggest enemy of his retirement wasn't the market volatility. It was his own desire to make things complicated. This one ETF strategy works because it removes the human element. It removes the FOMO, it removes the panic selling, and it removes the high fees. It allows the power of the entire American economy to do the heavy lifting for you while you go out and actually live your life. If you are just getting started, don't feel like you need to find the next Tesla or the next Nvidia. You don't need to be a hero, you just need to be an owner. By buying the entire market through one low-cost ETF, you are guaranteeing that you will capture the wealth created by every great company of the future. For Mark, this realization was like a massive weight being lifted off his shoulders. He stopped fighting the market and started riding it. And as a result, his retirement isn't just a dream anymore, it's a mathematical certainty. The path to financial freedom doesn't have to be a struggle. It can be as simple as one choice, made consistently, over and over again. Whether you choose a total market fund like VTI or the S&P 500 with VOO, the master key is already in your hands. But I know what some of you are thinking, and I know exactly what Mark was thinking at this stage. He said, okay, VOO is the king of growth, but what about SCHD? I keep hearing that SCHD is the king of dividends. If I'm looking for retirement income, shouldn't I be looking at the dividend giant too? It's the ultimate debate, total growth versus dividend income. To answer that, I did something a bit crazy. I actually took $50,000 and ran a head-to-head battle between these two titans. I compared the historical returns, the dividend hikes, and the actual spendable cash each one produces over time. If you want to see if VOO really is the only ETF you need, or if SCHD is the missing piece to your puzzle, you have to see the results of my $50,000 test. Click the video on your screen right now. I invested $50,000 in VOO versus SCHD, and I will show you and Mark exactly which one comes out on top for your retirement. I'll see you there.